How did risk pooling start in ancient mutual aid societies? Imagine communities coming together long ago to help each other handle life's surprises. That's how risk pooling began, as a way for people to share financial burdens from illness, injury, or loss. These early societies were made up of craftsmen, traders, and local residents who all chipped into a common fund. When someone faced a health crisis or a disaster, the group helped cover costs, spreading the financial risk across many people instead of leaving one person to bear it alone. The roots of risk pooling stretch back thousands of years. In ancient Babylon around 1750 BCE, merchants paid extra fees to cancel loans if their shipments were lost at sea. This was an early form of marine insurance, where the risk of losing goods was shared among many. Traders in ancient China and India also practiced risk spreading by diversifying their shipments across multiple ships or caravans, so if one was lost, the others could still succeed. This showed an understanding that spreading risk helps protect individual assets and reduces total loss. In medieval Europe, guilds, groups of craftsmen and merchants, formalized risk sharing. They kept funds to support members who fell ill, became disabled, or lost their tools. These guilds also helped regulate markets and quality, protecting members' livelihoods. Religious or community groups formed mutual aid societies that pooled contributions to cover funeral expenses or provide basic health care. These early efforts created a safety net for members, emphasizing collective responsibility. The Greeks and Romans added more sophistication to risk sharing with maritime contracts like bottomry. Ship owners borrowed money secured by their vessels, and repayment depended on the ship reaching its destination safely. If the ship was wrecked, the lender lost the money, transferring the risk of loss to them. This was a clever way to share risk and protect both parties, similar to modern insurance. All these practices laid the foundation for what we now call health insurance. They showed that pooling resources among many individuals can help shield each person from unpredictable costs related to health, accidents, or death. The idea that a community can share the burden of risks is central to today's health insurance systems, which use risk pooling to spread costs and provide financial protection for medical expenses. So, risk pooling in ancient mutual aid societies started as simple community efforts to manage uncertainties about health and economic hardship. Over time, these ideas evolved through trade, guilds, and maritime contracts into the structured insurance systems we relying on today. It's a story of people working together to protect each other from the unpredictable twists of life, building a safer future for everyone. Always remember to consult healthcare professionals for personalized medical advice, as individual needs can vary widely.